This is the second of the 4 lectures on Introduction to Algotrading that I'm providing to the class. As promised, this one discusses the contribution in previous lectures to the class made by Harvey Mudd alumnus Avi Thaker. There's a couple of reasons why I include him in this. One of those, and primarily, is because he's actually worked for the industry at some of the larger firms. I'm not going to name the firms. I don't think he would want me to do that. And so he saw things firsthand and what they were using, and talked a lot to the coders, was a coder himself, but also a strategist. And he did not give the class or me any proprietary information about what they do, but was able to describe generally their approach to trading and what he learned from them about the approach to others from trading. And also, he's able, in this slide set, to cover material that I otherwise wouldn't cover very much. So I was always grateful to him. I've always asked him to come and speak to the class for the last 3 years he's been here, 2017, 18, and 19. And I've actually reproduced in their entirety the lecture slide set from 2017 and 19. And I do want you to review that. And I left out 18 because most of what was in 18 was also reproduced in 19, a longer slide set. I'm not going to hold you accountable directly for the material in that, but I will hold you accountable directly for what I say in this video lecture about that. So I want you to take a look at those slides to see kind of, you can figure out his approach to this. This is the two of us at Ivan and Clara Wong's wedding in Menlo Park in 2019. I still see Avi a lot. We actually meet in person fairly frequently, given how far apart we are. And Avi is also working on the same kind of models I work on interactive brokers using IB InSync. So we collaborate quite a bit. He believes more in the more traditional kind of trading, like mean reversion and the like, than I do. And so that's why I think he's a good source to enable us to talk some about that. My first slide that I'm showing here is more whimsical than real. This is kind of the way Avi thinks about everything. This is his perspective on the way you think about getting traded, get going on your trading. He made this diagram. Maybe he got it from somebody else. It looks like he did actually get it from somebody else. But this is... he believes in high Sharpe ratios. That's his standard for trading, and it's also my standard for trading. And of course, he's an outspoken and articulate spokesperson for quantitative and programming skills. He feels just like I do that is really at the core of this kind of trading. Now, I'm going to only use some selective slides from this batch, some from 2017, some from 2019, to kind of provide an overview and to make a certain point about material you can actually draw from his lectures, even if you just look at the lecture slide. And I've chosen some of the more interesting areas that he talked about. So he sort of began in the presentation he gave in the way that I began in this series. You distinguish between high-frequency trading and trading that's not so high-frequency trading. Now, of course, in my case, I distinguished high-speed trading and high-frequency trading. I think he has high-speed implied in high-frequency trading. And as he points out, there's nothing new here. You've heard this from me. Relies on quick algo trading to capture small spreads or small alpha, less than 1 minute holds. So he's pointing out that what he saw mostly was either using spread arbitrage of various kinds, and not just the simple spread arbitrage I'm talking about in the class, and other trades where you're often in and out of the trade in less than 1 minute. He points out that it's difficult for the retail investor to get into because you can't get the equipment actually that is required. It's extremely competitive, and he believes that the fastest usually take the most profits, and he also points out that it makes up more than 70% of all trading volume on the big markets. In his material, he's mostly talking about stocks, whereas in my case, I'm mostly talking about options. When he talks about non-high frequency trading, he does encourage the same thing I do. He believes it's possible for the lone proprietary trader, the retail investor, to get in. And he believes that if you're really smart and you have good models, that you really stand a chance. This slide I'm going to talk about, or this topic I'm going to talk about directly, so I won't spend much time here, except I want to say that he had quite a bit more elaborate information about how this works than I did. Remember, on spread arbitrage, we talk about sometimes narrowing the gap between the bid and the ask, trying to at least have best bid or best ask, or both if you are a really fast trader. And of course, to some extent, that's the ultimate goal in spread arbitrage. In his discussion, when he came to class, he talked about what he saw where he worked, and I guess it's very common elsewhere too, where you're not necessarily just trying to place best bid and or best ask. There are other strategies involved in being elsewhere in the bid queue, say in second position, as is the case here for this number 5 on the second. This is best bid at 99.99, so this is just a penny below that. So he's saying that this trader might want to be the second order here, the fifth order there. He might want to be the second order here, the seventh order there. He gave a number of reasons about why it isn't only about jumping into best bid or best ask, because that's actually impossible on some of the large ETFs, because there's only a penny spread. And so if there's like 40 people trying to make that market, they're going to have to do it in some other way. He talked a little bit about why being in second place or on down the queue with a larger spread between your orders, like here, for example, this is 99.98, this is 100.02, so there's a 4-cent spread between this order here and that order there. As the market jumps around, this is still potentially very profitable. Now, he argues that this sort of thing was risky during times of volatility. This is where all the liquidity comes from, as we already know, on stocks and even on options. And he said you cannot trade this, of course, unless you are absolutely lightning fast. And with that, you have to have what he refers to as a good queue position. So even though I'm going to talk about spread arbitrage, the more simple form of this, and even showing you an example in the class, he pointed out to the class that there's more to it than just that there's alternative strategies or more deep strategies about being elsewhere in the bid-ask queue. Yeah, okay. He talked a little bit about something I don't say much about also, and that's basically alpha taking, which is typically in a stock market orientation. And again, I stress options more than I do stocks. Alpha taking is simply trying to figure out basically how to grab the profit that is to be found in the behavior of stocks. And mostly he was talking about the fact that there are various models that they use to try to capture alpha. I'm not actually very familiar with them. They're not what we call technical models so much typically. And he didn't say very much about them. And I'm actually not all that interested in alpha taking. In the same time, though, he started to talk about the mean reversion, as you can see in this middle slide point right here. And then he's also effectively talking about trend following, which is momentum trading. And it's because of that that I'm going to use those two examples from his lectures to amplify a little bit more on what he said, or to explain to you much of what is actually not included in the, obviously in the slides. I have an addition here. When Avi was talking about these strategies, I don't recall whether he talked about leverage or not as used by these big firms. So I make the note here, especially for alpha taking, that is trying to pull a profit out of simply the trending behavior or price behavior of stocks, for example, that these big firms use really high levels of leverage. I was told by one of the people back at Citadel, back in the days when StatArb was so popular, that their leverage on that was typically in excess of 100 to 1. So they were using money borrowed in the market to basically buy these positions, and they provided less than 1% of the capital. And so, of course, this means you can amplify what for a retail trader would be an unacceptably small rate of return into something more substantial if you're a large quant trader and are able to buy money at low interest rates. And we know, of course, that that is very prominent. On the other hand, the leverage, of course, really increases your risk exposure. And that ended up being one of the problems with statistical arbitrage when it kind of went south in 2006. Now, he also says this about technical indicators, which is my position as well. He says they're useless on their own. And this is the sort of stuff they talk about on CNBC, like Bollinger Bands and the RSI and the moving average convergence divergence ratio and stuff like that, KST and all of that. He says you really have to, he believes that you can look around on your own and find something that happens in the market, use indicators or come up with your own to represent what that thing is. I don't know really how strongly he believes in the usefulness of these kinds of indicators, even if they're custom made. I myself don't put much stock in them at all. He is one, though, that's big on data visualization. He said that it's crucial. You have to be able to see what you're doing. And I agree with him on the final point that he makes here, that the simpler you keep it, the better off you are. There's nothing gained, or not much gained, usually nothing gained, by trying to get overly complicated on trying to represent models on how the market works. Now, the reason I have this slide here is because of his emphasis on mean reversion and momentum. And I know Avi trades both of these. I trade one of them. I trade momentum a lot. And I have a momentum model that is more simple than the momentum model that he talks about here. But what he offers us here, which I think is very revealing, is the approach, I get the sense that is kind of the industry approach to mean reversion and momentum. I know that they experiment a lot with mean reversion strategies and momentum strategies. And as he says here, they tend to go hand in hand. And I think the value of this is that he talks about the sort of industry standard for starting out, which is the augmented Dickey-Fuller test and the Hearst exponent. So given that mean reversion and momentum still play a major role in the way these firms, individuals, he himself, and to a lesser extent, the way I look at it, I think we want to explore a little more deeply about mean reversion and the Hearst exponent and the augmented Dickey-Fuller test. And let's see what he has to say about it. Now, one of the reasons for this, emphasizing his approach to this, is when you take a look at what is called technical analysis, you can look at much more elementary mean reversion models like the use of Bollinger Bands, for example. I don't think Avi thinks very much of those. He believes, and I agree, that this is much more theoretically sound than that. And when I get to my discussion of what I find wrong with the technical mean reversion models, and I will get to that in this course, or why I don't think they work very well, this will surface and I'll be able to talk about it quite a bit more. He likes this because it is theoretically grounded, and I'm going to show you the extent to which that's true. So his next slide in that series was this, where he talks about the Ornstein BEC differential equation. We'll stop for a moment and take a look at this differential equation. Doesn't that look fairly familiar to you? This looks quite a bit like the geometric Brownian motion equation that we started with in our stock model. This isn't very different. We recognize right at the end we have the same Werner process that represents the noise, where we've got a distribution that's standard normal with a mean of 0 that is amplified by the standard deviation of the data series, or what we're hypothesizing to be the standard deviation of the whatever it is we're modeling. You take a look at the rest of this and you say, well, we're doing is we've estimated a mean, of course, and we are subtracting each observation, and we have a rate of reversion to the mean that we're going to try to estimate. And this is the variance of the process and the like. It's actually the standard deviation of the process. I don't know why people keep mixing those terms up like that. So this approach to the logical possibility of why it is maybe possible for mean reversion to happen is, I think, a good start. Now, I want you to think about this. I've said already that the mean reversion property is not possible in the geometric Brownian motion assumption. And again, the reason is that we've seen in the Monte Carlo simulations, if you get a simulation that starts to walk away from the mean, because that's going to happen in a few of them, there's no tendency for it to sort of look down and say, oh, we're above the mean, we're therefore going to have to kind of get back toward the mean. There's nothing mathematically that would take that model back to the mean if at the start it's walked away from the mean. So when you look at, if we're doing like 1,000 simulations like we were doing, you see some of them go way above the mean and way below the mean, and they don't have this tendency to return, because that's in geometric Brownian motion. There's nothing mathematically that tells you you have to go down because you're way up above the mean, because each new observation is completely independent of previous observations except the previous observation. Now in this, that disappears, and one might say, well, this is theoretically just as valid probably as the geometric Brownian motion, especially if one can argue in the psychology of the trader, they can feel that something drifting away from its mean is overbought or overvalued or undervalued, and you say that's actually common rational behavior, therefore let's model it. This therefore allows, I think, theoretically for us to accept this as something other than black magic. And so if we're going to take this approach, then let's stay with it. And so Avi points out in his slideshow that, okay, if we're starting with that, let's use the augmented Dickey-Fuller, or so-called ADF test. So I'm not going to go through this. You could go back and look at this. There's a reason why I'm not going to go through it. I've got another way for you to look at it. But what we're pointing out here is if you begin with that starting point, with that differential equation, then this is a standard method for evaluating the null hypothesis that we have. Let's see, I forget what the null hypothesis is that we do or don't have mean reversion property. I think a later slide has that. And the test statistic is this statistic that's shown right here. And so when he gets this value here, he says, I cannot reject the null hypothesis and therefore am unlikely to have found a mean reverting time series. So that's the significance of it. Now, when Avi went through this in the class, he didn't spend a lot of time on it. He had, like, I think 35, 36, 37 slides that he went through in an hour. He just had it up there so we will know that this is the approach that he saw people taking, and now it's the approach, I suppose, that he takes. And so what are we to make of this? Well, this is why I'm telling you, using Python is probably a pretty good idea. So you've seen the name of this. You've seen a little bit about it. I'm not talking about it very much. Avi didn't talk about it very much. What can you do about that? Well, I tell you what, why don't you go to Google and type in Python augmented Dickey-Fuller and see what pops up. And of course, you know where this is going to go. This is why we're using Python. This is what pops up, including many others as well. And I might add, by the way, that this is linked, this article right here, and I think 4 others, is linked from my literature page, where, and this is, you know, why Python is so valuable for us. Even if you don't quite understand what he's talking about in the slideshow, go read this, and not only does it very clearly explain how you use the augmented Dickey-Fuller test in Python, it of course also has the code. Sometimes, as I've said, this is becoming so easy that I think maybe it's better if you don't look this up and try to figure out and code it yourself. You'll probably understand it better. But then, of course, we would never get anything done if we did that for all things. So basically, you say, hey, I want to try this. I want to try to use the Dickey-Fuller test in Python to see if I can reject the hypothesis that it's not mean reversion. And of course, if you have a job interview from one of these companies, if you point out that you know this kind of stuff, that's going to impress people. But more to the point, I could easily use this in the class if we really wanted to get serious about mean reversion models for trading stocks. I may, in fact, we're going to get to it. I'm going to use a Bollinger Band, more elementary model when I show you this, but I'll remind you that we know a much more sophisticated way of doing it. Continuing on in the same theme, the Hearst exponent is similar. he talks about, helps to characterize the stationarity of a time series to see whether it is reverting, trending, or neither. Reverting meaning basically running as momentum. Trending, of course, is being reversion, and neither is the usual situation where you can't clearly see that it's doing one or the other. So once again, we have the math that's actually pretty easy to understand here. From the theory behind the Hearst exponent, you also have, this is not working very well. Okay, we have the values that you look for. If the Hearst exponent is under 0.5, you got a mean reversion. That's pretty simple to figure out, right? If it's approximately 5, if it's above 5, it's a trending process. Different periods, different stocks. And he even has the Hearst exponents for some stocks over here on the side, including Alphabet, Google on the bottom. So once again, you say, well, I kind of understand what he's doing here, but not exactly. What do I do? Well, you know exactly what you do, right? You go find an example. And here's, for example, I've got a number of these. This is our literature page. It's not the lecture slide page. Remember, it's the material page on background support material. So I've got 3 articles about the Hearst exponent alone on that page, including the first link here. And this is some of the code out of that link. You can't see it. I'm just pointing out that there's code. But this is out of PyPy. So you go down and you look at that, and you see this is Hearst 0.0.5. You look up the documentation. The code is there. You can have this thing up and running and testing in 20 minutes. And so it's better, I think, if you try to figure out what it's doing rather than get it up, tested, running in 20 minutes. But again, the libraries in Python are so massive that everything that gets talked about is well represented there already. So you don't have to spend all of your time trying to figure out exactly how you apply the theory in a model. For a student, it's ideal. You just go find the model, try to get the theory to the best of your ability, including the visualization, which really tells you a lot. And you can go very far. And what you're doing is sophisticated compared to a lot of stuff out there. So I'm having trouble making, okay. There's always something that's not quite working right. Now, I have this there because I don't talk about this anymore. I don't think pair trading is as popular now as it used to be. It's, again, theoretical. I don't think he's ever done any pair trading either, except in cryptocurrencies. Avi does trading in cryptocurrencies, and I don't. And I think he did have some success with pair trading in cryptocurrencies for a period of time. He tends to tell me, by the way, when he works on these models, that they work for a period of time, and then people figure them out, and then after that, they don't work anymore. And that is the curse of algo trading. If you have a really reliable model, and the last thing you do is tell anybody else about it. I don't even actually ask him about his direct models. I tell him some of mine, but only superficially, because there's kind of a rule, you know. You're working on your own model, you don't tell anybody about it, because if it's profitable, you want to work it for all you got until others figure it out. Obviously, as people crowd into the trade, then the trade no longer has value. So at any rate, this involved is when you're saying 2 contracts move together, or you understand the correlation between them, and when they move apart, you take a contrary trade. When one goes very high compared to the other, and the correlation coefficient breaks down, then the one that's high you short, the one that's low you go long on. And the most typical example, you either see examples like Pepsi and Coke, but you also see examples among the indexes, the E-mini S&P 500, the E-mini Dow. And they do tend to come back together after a while. And the Russell 2000, for example, in the Dow, and I've seen that. I don't know who's doing that now. From what I'm reading, that's not as popular as it used to be. This is what's being said in Reddit. Now, as I said, Avi really depends heavily upon the Sharpe ratio as his ultimate standard. And I do too. I think the Sharpe ratio is basically what you judge anything by. And he, of course, uses the traditional measure where you subtract the risk-free rate. I don't bother with the risk-free rate. It's essentially 0 now. But the denominator is the standard deviation of return, and you say of what? Well, usually of the portfolio itself. The cash value of the portfolio is what you run the Sharpe ratio on to evaluate it. Or if you have your portfolios divided up, like this is the portion dedicated to options, this is the portion dedicated to stocks, then if you're doing the option trade portion, you have to simply take the change in the cash in the portfolio as providing the substance for both the numerator and the denominator. And I do that, and he does that. And of course, the Sharpe ratio is better than just comparing to a standard like the S&P 500, because in options trading, for example, somebody says I made a profit. I said, well, I'm not impressed unless you can show me that sustained over time that the rate of profit you can make from that kind of strategy exceeds, let's say, the 5-year average of the performance of the S&P 500. And that's not even a worthwhile comparison, because options trading is way more risky than stock trading or trading in the S&P 500. That's what I tell students at Econ 104 to do if they don't know how to trade. Just buy an index fund and leave it there. That's what I tell them to do. Well, I wouldn't be saying that if that was a risky trade. So the only meaningful trade is the Sharpe ratio of your options portfolio against the Sharpe of the S&P 500. Because, of course, with a higher return, you also have a higher risk. And unless you can beat the Sharpe of the S&P 500, I'm not sure you have much of anything, really. I don't mean month by month or whatever, but smooth over a long period of time. Absolutely. So Avi certainly agrees with me on that. So I want you to go take a look at the rest of what he has to say. If nothing else, it'll trigger off your interest, perhaps, in something that I don't get around to talking about. He's around. He's at Mud all the time. And so you might someday track him down and talk to him. I'm going to have a few more slides that are indicative of his interest in machine learning, because I tell you nothing about machine learning. I don't think I'm qualified to do that. Avi actually worked for Microsoft for some time in a machine learning capacity, so he's really deep into it. He's a big believer in it, and I'm not going to show you all the stuff that he has on machine learning. You can find it for yourself, but I'll show you an example that he gave the class last year, his deep dive example. And so I don't know where he got this from. He probably said in class, but I don't remember what he said. So suppose you're trading wheat futures. Well, how would you use machine learning for that? It wouldn't be trying to figure out what the prices of wheat futures do or anything like that. You inform yourself on things like the 6 classes of wheat grown in the United States and the food products made from them. And so he's going to be someone who argues that you really kind of need to know quite a bit about the industry to trade in it or use machine learning in it. And my examples of natural gas are to that point. In that slide set, he talked a little bit about where these different kinds of wheat are grown and what you learn about it. And, how are they used and how important are each of these models? I know things like the soft white winter wheat is the only kind of wheat that produces suitable flour for making biscuits. And there's only one company in the United States that makes that, and that's White Lily. So I know something about it, for example. So what's this going to do, or what's this have to do with machine learning? Well, Avi and others are big on aerial imagery and the like. And so his thesis is, or somebody's thesis is, I forgot where he got this from, that crop health can be an influence on the spot price of a tradable good. So you using drones or whatever, or helicopters, or Google Maps, or whatever Google uses to take pictures from up high, satellite, I guess. Take aerial imagery of hard red winter wheat farms, using that as a proxy for health. Well, he says Google Earth gives us a free historical imagery over time. And he says machine learning models can learn the influence of crop health from market prices and then use pre-trained models that have been trained on large data sets. He's a big believer in this kind of application of machine learning to futures trading. And I agree with him about that. I don't do it like he does, but I certainly say this is exactly where you can apply this. He gave another example that I'll conclude with here, and that is the drone car counting. I think he actually did this. Basically, he's using image processing to count the number of cars over time in parking lots to better forecast the market. I gave you the story about how Professor Mitch Kubota used to walk into stores and take a look around to figure out whether he would invest in them. Well, it sounds like Avi would fly a drone over the parking lot and count the cars and how much those cars have changed over time, and would somehow generalize that, perhaps in a machine learning environment, into something that is tradable. Well, that's all I'm going to say about his. His material. I want you to go back and take a look at it. To the extent that I'm going to ask you something about it, because I don't want you to completely ignore it, I'm going to ask you about the augmented Dickey-Fuller, what it's used for, the Hearst exponent, and what it's used for, because those are the two examples I gave. And I may ask a small question about what are the examples that Avi gave us for machine learning. I do have to use the electric bullwhip to some extent to get you to look at these slides. That's all we have to say about Avi Thaker, so we'll post up the third of this series fairly soon. Goodbye, that's it.